If you're on the market to buy a home, you might be wondering some questions you would like to ask a mortgage professional. I'm here today with Sandra,
Hello, hello, hello. Thank
and
you for
she's going
having
to
me.
be answering some common questions we get from buyers in the mortgage side of things. So
Yes,
let's get
let's
to
get
it.
into it. I'm ready to answer these questions.
So, question number one, buyers ask, what is my buying power and what are the factors that determine my buying power?
So what we do is we take those monthly debts and we subtract them from half of your monthly income, and then we're left with a number, which is your mortgage payment, what you qualify for your mortgage payment. So that's exactly what factors into your buying power, is your debts, basically.
Nice. Yeah, because I met with a buyer this week and they said, what is the term buying power? I never heard that. So, what's another way you would say buying power is just.
Yeah, I mean, what I'm qualified for, that's your buying power. If I can only buy up to 420, that is my buying power.
Right.
Now, if certain homes have, sometimes homes can have a locked interest rate on them without having a buyer.
Mhm.
So let's say, today's interest rate is 7.5, but I only qualify for 420 at 7.5.
Right.
If that home is now at 5%, my buying power just opened up by another 100,000 or so. So I can now qualify for 520 instead of 420. So my buying power is typically just what I can qualify for. If
Right.
that makes sense.
Yeah, that makes sense.
Mm-hmm.
Now, on to the second question. Pre-approval and pre-qualification are two things that are commonly confused within each other.
Yes.
So, can you explain to us what's the difference of getting pre-approved and getting pre-qualified?
Absolutely. So pre-approval is kind of like let's say your buyer comes in and he fills out my application, but I haven't really taken a look at any of his income documents or any proof that this man is stating what is true.
Right.
He could put, I make $1 million on the application or whatever. Everything looks good on the application, but I have not verified any of his documents yet. So that is a pre-approval, is that, it all looks good on the application right now, from what this man is saying. However, the pre-qualification is when everything is looked over. I verified income docs, I verified asset docs. I've made sure that what this man is saying is true by verifying his documents. So pre-approval is kind of a lighter version of pre-qualification. You want that pre-qualification to be able to say, okay, I got my letter, I'm ready to go shopping. This is my lender said I'm okay to go, and
Right.
That's good. Yeah, that's what it is.
Definitely. And what are the required documentations you need to get that pre-qualification letter?
Yeah, so it depends on your situation, but typically for a W-2 buyer, we ask for your driver's license, your 30 days worth of pay stubs, 2 months worth of bank statements, your 2 years W-2s, and that's really it. If you're self-employed, we ask for 1099s, 2 years worth of tax returns. If you have investment properties, it's going to be on your tax returns, but we'll need lease agreements and stuff like that. There's a bunch of things we dive into further in the process, but typically to get pre-approved, just your normal income and asset documents.
Great. And what type of loans do you offer?
So we offer a bunch actually, but we offer all the normal ones. We offer conventional loans, we offer FHA loans, VA, USDA. We now do HELOC loans as well, which are home equity lines of credit. Nice. So if you're sitting in a home and you want to pull the equity out, we offer those as well. We offer, bank statement loans. So for the average person that maybe gets paid in cash or it gets paid in tips here in Las Vegas, we do offer bank statement loans. So whatever you are depositing, we take 12 or 24 months worth of bank statements. We average that out. That's your monthly income. So, we have a lot of creative financing that we offer. DSCR loans are really cool as well.
Yes.
Those are for investors. I'm sure you've heard of them. Yes. But for those of you who haven't heard of them, it is a loan where we don't require any income documents at all. We don't need to verify your employer or where you work or how much you even make. All you need to do is have a primary home already, and then you just have to have 20% down, and then you can buy an investment property. So it should close really quickly. Interest rates are a little bit higher on those, but it's still a really nice option to have. So we offer a bunch. We're getting creative.
Yeah, that's good. That you want to work with a lender who offers many type of loan products.
Yes. So we want to make sure that each loan product is tailored to you as the buyer. There's multiple different options available, so we just want to make sure you're picking the right one. Yep. And typically when we're in a buyer's consultation or when we're talking about these loans together, me and Kevin will sit down with you and we will go, line by line exactly which loan looks better for you, whether this down payment is better, whether this monthly payment is better. Do you want mortgage insurance or not? What's the best option? So we will definitely hold your hand through that.
Yep. So that goes along to my next question. One of the biggest misconceptions is that you need 20% down. So what's the minimum downs you need for each loan products?
Yeah. So if you're a veteran, you are lucky and not lucky, you've worked your ass off to get it. But the advantage of having a VA loan is you get to put zero down. So for VA buyers, you have a zero down payment, which is awesome. If you are a disabled veteran and you receive disability, then you have no funding fee as well. And what the funding fee is basically it's built into your loan amount. So it's typically about $8,000 to $9,000 from what I've seen in my experience. And that is because we are giving you this loan with 0% down, and you have a funding fee built into your loan amount. But if you're disabled, you have no funding fee either. So you're literally coming zero out of pocket for veterans. For down payment assistance programs, you can put down as low as 1% and we'll come up with the other 2%.
Nice.
So there's different grant options available depending on how much annual income you make, then you may qualify for those programs. Conventional loans, you only need 5% down. FHA, you only need 3.5% down. And for investment properties, that's when you put the 20%. That's where I think people mostly hear that misconception. But it's only for investment properties where you only need 20% down.
Got you. With conventional loan, can you get it lower than 5% with the Fannie Mae?
Yeah. Yep. So there are conventional loans that offer that 3% down, and that was kind of like that grant option that I was telling you. So you come up with the 1%, we'll come up with the other 2%, and it is a conventional loan. So there's multiple options out there for how much you want to put down, just depending on what your qualifications are for that product.
Oh, nice. So another question buyers have is, when is the down payment due? Because a misconception is that the earnest money deposit is the down payment. What the earnest money deposit is, it's basically a deposit to secure the home, have it off the market. It's typically 1% of the purchase price. And that's just to ensure the seller that you're serious in purchasing the home. They take it off the market and you do your due diligence.
Yeah, that's a great point. A lot of people think the down payment is what comes right at first to reserve that home, but no, that's just the earnest money deposit. So you are putting a deposit on the home, like you said, to reserve that home and take it off the market, but then the rest of your down payment and closing costs and everything at the very comes out at the very end of the transaction. And then your earnest money deposit that you gave to title in that escrow account in the very beginning of the transaction, that is credited to you at closing. So yeah, basically everything comes out at the end. The only thing you are paying for up front is the earnest money deposit and certain things like appraisals and inspections and stuff like that. But the down payment total and everything, closing costs, comes out at the very end.
Yep. So on closing days when they are
closing day, yes. Yes, sir.
So another question buyers have when they're speaking with mortgage lenders is, how do they qualify for a second mortgage to purchase their second home?
Okay, yeah. So again, if you qualify, so we're going to count both of those mortgages against you. Unless you already have a renter signed up to lease that home, we are going to count that mortgage against you. So that means you have to qualify for two mortgages unless you have a renter set in place. So it's pretty easy. We're just going to put let's say you want your current primary home to become that investment property. That's totally fine. We'll just make that as a lease, and then you will be able to qualify for your new current home as well. So if you already have a renter set up in place, that's great. We will not count that mortgage against you, and they can just move in and you move into your new home. So it's truly an easy process. There's nothing really too crazy with that.
Right. And if they do have a tenant in place on their first home, can they use that rental income to qualify for a larger mortgage?
So no, so we will not be using, so you have to have rental income for at least a year, and it has to be on that tax return. So that's a great question. So a lot of people are like, hey, I have a renter signed up. Can I use this renter to, so I can qualify for more? Can I use this income to qualify for more? That is not the case unless you are buying a fourplex. So if you're buying a fourplex, we can take that renter's income that's going to be in the other 3 units. We can use that as income to qualify you for a new home. You just have to live in one of the units for a year as well yourself. And then after a year, you can move out and then you can use all that rental income for your new home. But yes, if you're buying a single family residential home or a condo or anything like that, and you have a renter signed up in place, we can't use that rental income until you've come up on a year, and that is showing on your tax returns that you wrote it in there.
Oh, great.
Yeah.
That's great information to have.
Mm-hmm.
And just a follow-up question on that. You mentioned with the multifamily, duplex, fourplex, you are able to use that rental income. How much of that rental income are you able to use?
So typically we'll take, there's a calculation that we do on the back scenes. I don't really know the math off the top of my head, but it is a calculation that we do on our side. So we'll typically take like what we think you could be getting for rent based off rental incomes in the area, what rents are going for around in that neighborhood. So we will do that calculation and for you and see exactly what we can use for qualifying income. And what's great about the fourplex thing is you only need 5% down on those. So it is technically an investment property, but you only need to put 5% down and not the 20% that I mentioned earlier. So there's these little tips and tricks that people really don't know, but it's like a huge thing that you can put 5% down on this huge investment property. So
yeah. So something that's been very popular in the Las Vegas area are these new build homes that have a next gen suite or a multi-gen suite.
Yes.
Which pretty much it's its own suite that has this kitchenette, bedroom, washer and dryer. Individuals yes. Individuals have asked me, are they able to rent that suite out and use that to qualify for a mortgage?
So no, unfortunately you cannot. Those are still considered single-family residential homes, so we cannot use, the rental income that you would get from a room, if that makes sense.
Yeah.
So long story short, no, you may not.
So over the last few years, we've witnessed in the Las Vegas market homes be bought by cash buyers, institutional buyers, and investors. To have an enticing offer nowadays, you need to have a quick closing. So
yes.
What's your timeline to get from offer to closing day with the mortgage process?
Yes. So I like to be really transparent with my buyers and my agents. I definitely do not want to overpromise something.
Yeah.
So I always like to put 30 days on the contract just in case, anything can go wrong. I am very extremely, I pride myself on the due diligence I do up front in the process. So I like to make sure that, I'm going to hound you and I'm going to be really annoying in the beginning of the process and you're going to hate me, but it's going to make everything easier in the end. And there's going to be no hiccups during the process. I like to put 30 days on the contract, and then at the end, when I'm done with everything in 2 weeks, I like to have good news when I pick up the phone, and I'll be like, hey, Kevin, hey, listing agent, hey, buyer, we're all done on our side. Can we close 2 weeks early, or can we close a week early? So typically, I have done closings in 14 days. I've done closings in 20 days, and I do have a track record for closing loans early, but I don't want to overpromise anything up front. But yes, so typically 30 days is what I like to tell the seller. However, I know that we can do it better than that and we can close it earlier.
So this is great when you are buying a home. You would like a lender who has that track record to close early. It's definitely enticing for the seller to have that in their back pocket, like, hey, we can close within 14 days and it's a mortgage, not a cash offer.
Absolutely. And to piggyback off of that, I love to call the listing agent myself as well. And I'll tell them like, hey, everything that this buyer, they've presented you the pre-approval that I have provided them, and I've vetted them. I've looked at all their documents and everything. I don't see any hiccups, or I'm not foreshadowing any problems within, later in the process. So I think we're good. And then that extra step that we take in our process gets offers accepted 9 times out of 10. So it's definitely, it's huge. Who you work with really matters, and it's huge to have, good people in your corner.
Yeah, definitely. You want to build that all-star team when you're purchasing a home, such as your real estate agent, your mortgage lender, and the title company that you ultimately choose to close with.
Absolutely.
Yeah,
definitely.
I'm kind of putting you on the spot here,
yes,
Sandra. So do you work on weekends? As buyers, they typically look at homes when they're off work, and it's typically on the weekend or after 5 o'clock. And sometimes they really like a property and they want the numbers run and see kind of if it makes sense for them. Is that something that you do?
Absolutely. Listen, Kevin, if I was a 9-to-5 lender, I think I would lose out on hundreds of more deals, because it's really important to be able to be available when your clients are available. And like you said, they aren't available when they're at work, when I'm working.
Right.
So I need to be available after 5 p.m. I always tell my clients, even if you have a question, you're sitting there in bed and it's 2 a.m. and, all these questions are running through your mind and you're like, wondering, oh my gosh, how much is this going to cost? But wait, what if I want this house instead of the other one? I want you to text me all of the questions that are popping up in your head at 2 a.m. I'm not necessarily going to answer them at 2 a.m., but I want you to get them out so you don't forget them the next morning. And
Yes.
you know what I mean? I want to address everything as soon as I wake up in the morning.
Yep, definitely.
But we definitely, working weekends is crucial, and being available for your clients 24/7 basically is really crucial, especially in this industry. We're young, we're hungry, we're ready to get it. We're
Yeah.
working 7 days a week, 24 hours a day,
Yeah.
Kevin. We gotta get this bag.
Yeah, definitely. I've seen that with some lenders that buyers work with. They don't work in the weekend. They see a home they really like on Saturday, but they'd like to run the numbers, and they have
Yes.
to wait until Monday, and then that home gets swooped up, or it has another offer, and now you're competing with another offer.
Yes.
When if your lender reached out that same day, you could have submitted your offer on Saturday.
Exactly. Yep. And I always tell, if you're going house shopping on Saturday or Sunday, I will be on my laptop ready to run numbers for you on that home. So you're prepared to write offers within 2 hours if you need to. Because I would hate to be the reason that my clients looked at this home and they loved it so much and it's their first home, it's their dream home, whatever. And I didn't respond for 2 days because, it's Saturday, I'm at the pool instead. No, I'm bringing my laptop to the pool, if that. And you know what I'm saying? So definitely working weekends is crucial.
Nice. Yeah. So when we refer to running numbers, can you kind of break that down, what type of numbers we are talking about?
Yeah. So typically when you go house hunting, Kevin will send me the address. Let's say you guys really like this home or you really like 2 or 3 of them. Kevin will send me the addresses and I will research the property taxes, if there's an HOA or not on the property. I will estimate the homeowner's insurance on that home. I will break down exactly what is in that monthly payment. So HOA, property taxes, homeowner's insurance, just so you realize we'll get a really close estimate to what you are going to be paying monthly so that you are comfortable with that. And then, if you want to submit offers, you can do it that day.
Yeah. Mm-hmm. Yeah, because that's something that I feel a lot of buyers are concerned with. They like the home, but now they'd like to know the cash it takes to close and then what their monthly payment would be.
Yes,
so
exactly.
That's definitely something that she will work with you, provide those numbers, and if it all makes sense, we can submit that offer.
Mm-hmm. Yeah, and it's interesting because sometimes, my clients will like a more expensive home, but that monthly payment might be cheaper than what the less expensive home would be, depending on what their HOA is monthly or what their property taxes is. So it's interesting to see the pricing breakdowns for each purchase price.
Yeah, definitely, because the purchase price can be $400,000, but like you mentioned, that HOA, property taxes can completely differentiate the monthly payments.
Exactly, and then it could totally ruin the taste you have for that home.
Yeah.
So it's like, oh, you really think you like this home, but it's like, oh wait, it's cheaper, but it's all more expensive. No, let's offer on the other one. So
right,
it all comes into play there.
Definitely. And you touched on mortgage insurance. Can you kind of explain what private mortgage insurance is?
Yes. PMI, that's private mortgage insurance. That is for conventional loans. So if you are putting less than 20% down, you will have private mortgage insurance. And this is something that we pull on our side. We don't control, you can't shop for mortgage insurance. This is just something that we are given to by the government. You know what I'm saying? We pull the quote and it's just what it is depending on the price of the home, credit score, interest rate, all of that kind of comes into play there. But it's typically around, I would say, $150 to $200 a month if you are putting less than 20% down on a conventional home. However, if you are putting 20% down, that means no mortgage insurance for you for the life of the loan. So that's really cool. That's also why some people like to put 20% down, because it does end up saving them, $150 to $200 a month. But FHA is a different ball game. So if you're buying an FHA home, you will have mortgage insurance premium. So that is already mortgage. It doesn't matter how much you're putting down, you will always have mortgage insurance throughout the life of the loan. However, if you put 10% down, this is a weird one, but if you put 10% down on an FHA loan, then you can get rid of your mortgage insurance premium after 11 years.
Yeah.
But no one's going to call you and tell you, hey, 11 years is up, you don't have mortgage insurance anymore. No, you actually have to call your servicer yourself, which would be me and my company. Yeah. You would have to call the servicer and be like, I want to drop my mortgage insurance. It's been 11 years. Get rid of that. So it's interesting. But yeah.
Yeah. Mm-hmm. So for the buyers who do put less than 20% down, is there a way to avoid PMI, or does the PMI fall off at a certain time?
Yes. So private mortgage insurance does fall off after a certain period of time in the loan. So once the loan balance falls below 80% of your home's original value, that's when you, again, have to call the servicer yourself and be like, drop my mortgage insurance because I'm, at 80% loan to value at this point. So
Yeah.
that's when it can fall off.
And for FHA mortgage insurance, does that fall off?
No.
No.
So it doesn't ever fall off unless you put that 10% down. It falls off. It can fall off after 11 years, but you got to call them yourself. It's not going to fall off by itself.
And is there a way to remove mortgage insurance with the FHA by refinancing to a conventional? Is that the only way?
Yes, exactly. Okay, so that's a great point. Yes, so you can refinance your FHA loan. I mean, you can refinance whenever it makes sense for you. If you want to, get rid of mortgage insurance, if you want to lower your monthly payment, if you want a better interest rate, you can refinance into a conventional loan. And then if you want to put that 20% down once you refinance, then it'll fall off.
So this is a thing that we're seeing in today's market with the higher interest rates and homes sitting a little bit longer on the market. We're able to negotiate for seller credit. Can you kind of dive into the details on the limits that we can use on seller credit depending on the loan type?
Yeah, so there's a bunch of factors that go into this, but to just keep it short and sweet and to the point, for a conventional loan on your primary residence or a second home that you're buying, the seller is allowed to give you, depending on your down payment. So if you're putting 10% down, the seller is allowed to give you up to 3% in seller concessions. If you're putting 10% to 24% around there, then the seller can offer you up to 6%. And if you're putting down up to 25% or more, the seller is allowed to give you 9% towards your closing costs, discount points, buying down your rate, all that kind of good stuff.
Yep.
For a conventional investment property, if you're putting 15% down or more, the seller is only allowed to give you 2%. For a FHA home, the max cap on this one is 6%, no matter how much you're putting down. And for VA, so it depends. So just for closing costs and prepaid items and certain things like that, it's unlimited. The seller can give you as much as they would like and as much as you negotiate. For your buy down and like discount points and like certain things like that, you can only get up to 4% from the seller. But yeah, there's multiple different areas to that, but to keep a long story short, yeah.
Yeah. So just to piggyback on that, can you touch base as well on what a permanent buy down is, a temporary rate buy down? Because with the seller credit, we're able to use that to cover some closing costs, or especially in today's market, to buy down your interest rate.
Yes, so a temporary buy down, that would be like a 2-1 buy down or a 3-1 buy down, which simply means the seller is giving you a credit, or you could also buy it down yourself. To buy down the interest rate for 2 years or 3 years only, so it's temporary. So it's going to start off, let's say, for example, let's say we're at a 7.5% interest rate today. So you'll buy it down to a 5.5% interest rate for the first year. It's going to go up the next year to 6.5%. And then if you have a 2-1 buy down, it's going to go up to 7.5% and then stay that way for 30 years. If it's 3 years, it's going to go down from 4.5 all the way to 7.5 after that. I don't know if I'm explaining that.
Yeah, no, it makes sense. And then buyers, don't confuse this with the ARM loan. This is way different.
It is totally
you
different.
have to qualify for that original rate that you so if it was 7%, you have to qualify for that to do the 2-1 buy down.
Yes, exactly. Mm-hmm. Now, however, if you are doing a permanent buy down, you can just buy down the interest rate to 6.5%. And then, it could stay that way for 30 years. So it's depending on what you want. I like to recommend 2-1 buy downs to people that are anticipating a raise. So that's good for like maybe teachers, maybe firefighters, police officers, doctors. If you are, if you're not worried about a payment shock later down the road, because you're going from 5.5 interest rate to 7.5, that's going to be a lot of difference in your monthly payment. So if you're okay with that difference within that 3 years, then I recommend it for you. But the whole point of a temporary buy down is to be able to buy it down, and then let's say interest rates drop the next year to lower than 6% or whatever, then you refinance that interest rate. And then whatever you did not use, whatever money wasn't used in that temporary buy down goes directly to your principal payment. Yeah. So it's a nice way to kind of save money.
And like she mentioned, that additional money that isn't used to subsidize that payment, it's in an escrow account and you can use that as well, correct? If you refinance.
Yeah, if you refinance it so that it goes directly to your principal payment and no money is wasted, basically. So if a seller gives you that money, it doesn't just go into the ether and we don't take it from you. It goes to your monthly payment, your principal payment, excuse me. So it's nice.
Yeah, and as opposed with the permanent rate buy down, if you use that to buy down your rate, that money is just gone, right?
Yeah, well, that money is then
if you refinance.
Yep, that money is then used towards that interest rate. So you bought that interest rate to be down to 6.5, 5.5, whatever, and it's just like that permanently. So there's no change in your monthly payment unless you refinance.
Yeah. So for a buyer who's ready to get started with the pre-approval process, how can they do that and get in contact with you?
Yeah, so they can either, if you're coming through Kevin, you can just text him and be like, hey, I'm ready to get pre-approved. Kevin's going to set you up with me in a group chat or a group email, and I will then set up time with you to schedule a buyer consultation over the phone. It's really quick. I just want to get to know you, get to know your goals, and see what's important to you, see exactly what you're expecting in this process. And then from then, I will send you my application. It takes about 15 to 20 minutes to fill out. It's just all your personal information and stuff like that. So I can take a look at that, know what documents to request from you. As soon as you send me all the requested documents I need, the faster I can get you a pre-approval and get you out there house shopping. So it's really as simple as that. We can put the application and everything, link in bio, and that's
I'll have that in the link in the bio.
Yeah, absolutely.
Hopefully we answer some questions that most home buyers have when they're speaking with the mortgage professional. I'm Kevin Reyes. I am a licensed real estate agent in the Las Vegas area, and this is
Sandra Mijan. I am your mortgage professional here in Las Vegas, Nevada.
And we look forward to working with you in your home buying process.